What is up, guys? Welcome back to another video. My name is Nash, and today we're going to be talking about one of the biggest trading differences between index funds and ETFs. So this is going to be one of those things that you're going to notice when you purchase index funds versus when you purchase ETFs. A couple months ago, I was shifting my investing strategy from individual stocks to mostly having index funds in my Fidelity portfolio, and this was one of those things that I had to learn on my own. So I thought I would share this with you guys just in case you were investing in index funds and that you were seeing something like this. Alright, so whenever you purchase index funds, you have to purchase those through a fund manager, right? So the manager might be an individual. It could be a company like Fidelity that hires managers to manage those funds. It could be maybe Vanguard. It could be Charles Schwab, I believe, and there's also BlackRock. And there's a lot of them that have their own funds. And most of the time when you look at the names of these index funds, you should be able to tell which company they are from. So the ones from Fidelity, they always start with an F. From Vanguard, they start with a V. So you can only purchase these from the fund manager, right? Which could be the website or the company that has the managers that manage the index fund. So you're not going to be able to purchase index funds on Robinhood because Robinhood does not have its own index funds, right? But what you can do is you can actually purchase an ETF that follows that index fund, right? So that's kind of like the difference between the two. So the ETFs are going to be tracking the index funds, and the index funds are created and managed by the fund managers. All right, so when I started buying into index funds, one of the things I noticed was that every time I would purchase an index fund, let's say in the morning or any time before the market closed, the trade would not execute until the market had closed, and then the trade would execute, and this was mostly at night. So I was really confused. So I tried purchasing these index funds during different times of the day because I thought maybe if you buy it in the morning, the trade doesn't execute. If you buy it in the afternoon, maybe it's too late, so it takes a lot of time. Everything I tried did not make a difference. So I went and did some research, and what I found was that there's a manager who was actually executing the trades, and they can only do that when the market is closed. And the manager can only execute the trades whenever they finish calculating what's called the net asset value. This is going to be the net asset value of the entire fund, and this is going to affect the price of the index fund. So in the morning, the fund might be, let's say, $90 a share. By the time the market closes and the manager calculates the net asset value, the price might jump to $95 or $100, right? Because the net asset value went up, or if it went down, the price would go down as well. So there's a formula to how you can calculate the net asset value, which is going to be assets minus liabilities of the fund divided by the number of outstanding shares. So this is going to give you the net asset value. This explains why your trade is never going to be executed during the day. It's only going to be executed after market close and after the fund manager calculates the net asset value. Let's say you see an index fund that's $90 a share and you want to buy 10 shares of that index fund. So let's say you purchase this in the morning. As soon as the market opens, you go ahead and purchase that index fund, and by the time the market closes and the manager does his thing, you find out that the price has gone up to $100 a share. So now you don't get the 5 shares, you get way less, right? You get maybe 3, 4. I'm not really good at math, but one of those. To fix this, index funds allow people to purchase using fixed dollar amounts, right? So instead of saying I want to buy 10 shares, you can say you want to buy $1,000 worth of this index fund, and by the time the manager calculates the net asset value, they're just going to use that $1,000 to purchase however many shares it's worth at the time, right? Alright, so when it comes to ETF, these are the complete opposite of index funds. You can buy these on Robinhood, on any trading platform. Honestly, you can even buy ETFs on Fidelity, on some of these fund managing websites. The biggest difference when it comes to ETFs is that you're going to be able to buy and sell anytime. So it behaves like a stock. So I guess you can look at it like a stock because you can, day trade 5 seconds apart. And when it comes to purchasing an ETF, you can trade in dollars, you can trade in shares, depending on what your brokerage allows you to do. I know Robinhood allows you to do both. Alright, so to sum it up, you cannot day trade index funds because whenever you purchase index funds, they're usually for a long term, right? You're supposed to hold them for a year, 2 years. That's when you get a lot of the gains. And ETFs, those you can day trade because they're just like a stock. You can buy and sell anytime, and they're more liquid compared to index funds. So that is pretty much it for this video. Thank you so much for watching. Make sure to go ahead and hit the subscribe button below if you haven't already, and I'll see you on the next one. Peace.